Hey traders and investors, it is Thursday, July 17th. Taking a look at the charts, equities are a little bit mixed. We have the NASDAQ slightly positive while the Russell is down 0.4%. I got the S&P 500 pulled up here. Overall, the market is just consolidating and digesting. It is actually putting in a short-term cycle low. We've got actually a few things starting to play out here. So more or less, this is a potential bull flag pause. The market is trying to figure out if it's going to have another push higher, which the trend is up and it is pointing to higher pricing. And of course, I think we could see the S&P 500 continue to run up. Now, when we dive into the chart analysis, I'm just going to go the SPY just because that's what some of my trading indicators are based around. If we take a look at the SPY, we can see here we've got on the daily chart, we actually had a short-term cycle low. And this short-term cycle low is what happened in the last two sessions. We saw the market sell off. It came back down. This is after a pause for about a week. And that is usually a short-term oversold kind of dip. So based on a short-term cycle, you can see we've had some other cycle lows. If I was to just throw some lines on here from these lime greens, we had this other cycle low through here. We have another one-day cycle low over here. You can see how it kind of stands out, these pauses in the market, these pauses on the chart. And that's kind of where we are as of yesterday. The market flushed down, started to rebound with a short-term low. Now, if we look at the futures chart, I'll just go back to the S&P 500. We actually have a little bit of an oversold level here on the S&P 500. This lime green saying, hey, it's a little bit oversold. We also did see some panic selling right over there. So we saw panic selling drive in here. Then we got oversold. It had a flush and sell off, a flush down. So people panicking out. And then, of course, the market typically, when it gets oversold and you have a short-term oversold panic wave, usually the market quickly rebounds. These are usually emotional kind of swings, or kind of a washout low. And so we saw a bit of a bounce there. So today, again, the market is digesting, trying to figure out which way it wants to go. Where is money flowing today? Well, it's mixed with stocks. We are seeing money actually move out of bonds a little bit. Again, bonds are moving down. We talked about this big bear flag into the 150-day, up into a significant kind of resistance area, a very significant pivot zone through here and pivot highs and through the middle of noise. It has reversed down. And if we just look at this chart, we did a little Fibonacci extension on this last week saying, hey, if it's based on this drop and this rebound to this high, we should see it move down somewhere around the 110 level. Now that this is futures, let's actually go to TLT, which is kind of what most people would trade. If we go from the high down to the low and up to this high, you can see here. Let me just move this. Where's that line? Let me just move this over. So you can see here yesterday, we've seen more or less the market flush down pretty much to that 100% measured move, close enough to say that that has been reached. But overall, it still may want to, the overall trend is down. And I wouldn't be surprised if this continues to break down and go lower. I talked about, I think it was last week, bonds pointing to much lower pricing and how the yields are pointing to higher yields. And of course, if yields go up, which they have been going, bonds are going to go down. And the big picture of yields, the very big picture of yields is super bullish. It is still pointing to some crazy high yields. Whether it happens or not, and whatever, everybody's got their opinions. People seem to be very strong on interest rate opinions. But the charts don't lie. The charts are pointing to higher pricing. And if they go higher, bonds are going lower. And that's just kind of where we're at this point. Higher yields will no doubt crush businesses, crush the United States, the debt, all of that stuff. But just because it could do that doesn't mean it's not going to do that. As we saw with oil can go negative. Nobody thought it could. And a lot of people lost their shirts. And you just have to realize it's not about what you think and feel. It's about what the charts are doing and following the money flow. And that is kind of where we're at. So let's take a look over at gold. Gold down a little bit this morning. I did not cover gold, silver, or miners yesterday in the report. And got a bunch of people wondering, why didn't I cover it? Well, sometimes I don't cover everything. And we've talked about gold 1 billion times. And gold is in the same consolidation. It has been going sideways for 2 weeks. If I don't bring something up, it's generally because nothing has changed. So you don't need to get all panicky and worry about me not covering it. Usually I try to cover stuff that actually has some interest and that's pending and or moving. Not always. I sometimes miss some big moves in the market in a morning video if I didn't quite catch it. But again, something that's been trading sideways for months and really has no movement isn't really worth covering. Whatever I said yesterday or the day before is the same thing that I would repeat. So gold consolidating in a bullish chart pattern, still pointing to higher pricing. If we do have chaos in the equities market and some bad news, we'll probably see this shoot up, and it's primed and ready at any point to do that. If we take a look at the US dollar index, the US dollar index is having a nice little rebound over the past couple of weeks. It's trying to really scream higher. There's some big volume going on. Not sure what the catch is there, but definitely it is pushing up, obviously, into this blue line, which is the 50 EMA, the 50-day exponential moving average. And we'll just see if this is eventually going to try and put in a significant bottom or not. Obviously, if this keeps going up, then we could see the currency conversion with the Canadian dollar, US dollar move into our favor. If I pull up that chart, we can see here, it looks like this is the US dollar, Canadian dollar. So this is the currency exchange. So one US dollar is worth $1.37 Canadian. I know a huge chunk of you, including myself, are Canadian, so we obviously want this to go higher if you're holding US dollars, which I am, and I still believe the dollar, this currency exchange is going to go higher. Now, overall, one of the big problems with obviously trading and all of that is people always seem to move into the markets during some extreme times. Okay, here we go. So long story short, come last December, and really through kind of February, through this whole area, this was a very critical turning point in the market. This is when a lot of emotions were flying high. It's also when we had quite a few new investors come on board because there was a lot of uncertainty going on. And a lot of people moved into the US dollar up here, which is, as I'll show you in a minute, is a very high level. And of course, now we're hitting an extreme low, and we have a lot of people panicking out of the dollar, a lot of people giving up on it and moving. And this is signature. I've seen this for 25 plus years. You always get a bunch of people making decisions at these critical turning points. And they make a decision, and then obviously we've seen the currency move down quite significantly from that high, and then people will get out, and then of course it could continue to go much higher, and they will have missed out on the move and taken a loss. That's how the market works. So this is where I think we're reaching an extreme low here, just like we reached an extreme. So anybody who purchased and converted to US dollars up here have been feeling the pain because they more or less converted at a high, at an emotional level. And that's okay. That happens. And of course, we also have people now bailing out of the Canadian or the US dollar. And of course, I think they're doing it at a significant pivot low. So let's just go back, and I don't know how to use bar charts very much, or not bar charts, trading view. I'm struggling with right clicking. I can't right click on anything in here to reset scales. I don't know what's going on. Maybe I'll just try reloading the page. Okay, I just reloaded the page. Looks like I can scale stuff. So here we are on the daily chart. I'm going to go to the monthly chart. So we just talked about how most people make decisions and jump ship and change strategies and make emotional decisions near major highs. They also do the same at major lows. Now, if we go to the monthly chart and zoom back on this big picture, you can see here the dollar currency exchange has gone up to about $1.45, $1.46 several times, and it's always had some type of pullback. Again, the overall big picture here, if we look at Fibonacci extension, is you go from the low to the high, down to these lows, and it'll project where this potential pattern could go. Now, this is definitely an extreme pattern, much like the extreme with the interest rates going to 8% if that chart pattern plays out. But this pattern is pointing to potentially a $1.52 and then all the way up to about $1.73, meaning chaos is coming in the financial markets, and there's going to be all kinds of crazy price swings in the markets. But overall, when we take a look, again, each time we get up here, these spikes in price is when a lot of people make emotional decisions and they jump ship and they change strategies or they get into something at a high. Now we're down into a really critical support level. The daily chart shows we're settling into support. We're on the verge of starting another move higher, which potentially could be very favorable for the US dollar. I think a lot of the downside risk from the spike has been wiped out. Obviously, we want to find a bottom here. We don't want to see this continue to go down if you're holding the dollar. I'm obviously keeping my eyes on that because I don't want to ride this down to a big extent. But the long-term picture here is still bullish with the US dollar. So with that said, I know one of you wanted to talk about our URA, got into uranium. We had, let me actually just... uranium, we did play recently with this trade here. We had the stock market change direction. We had a nice trade to the upside, hitting our targets. Uranium just continues to muscle its way higher. Now, we did have another, sorry, I'm all over the place with the mouse. We did have another buy trigger here a couple of days ago in uranium. It's starting to pick up. It does have a bull flag pattern. I know some of you got long. This looks like a pretty good trade. If the stock market is going to have another push higher, this is most likely going to keep muscling its way higher. And just remember to lock in some gains fairly quickly. This market could turn on a dime to the downside, and that's how we always trade these band trades, which stands for best asset now. We move into these sectors. We always trade, sell off a quarter or half of the position at a first target. It could be 3, it could be 6%, something to reduce our risk and lock in games right away and move our stop up. If this trade is going to continue, it should have some explosive move, and you can make it up with the much higher targets you want to put on it, 15, 20% for the next leg. But if it rolls over, you want to make sure you've moved your stop back to break even or just below it so that you barely lose anything, or you make a small profit if it does roll over. And again, that comes back to when we look at the overall stock market, like the NASDAQ here. I talked about this yesterday. When we hit our 15% target in the NASDAQ, we tend to see volatility hit the stock market. Now, it may grind a little bit higher for a week or two, potentially, but usually we go into a multi-week correction that resets the market. We see red bars. Potentially, if it turns back up, we have green bars, and we play the next leg higher as well. But you can see the volatility. We gapped higher above our 15% target. We got a good fill, and then yesterday we saw it pull back and sell off and then rebound. Volatility is now in the air, and at any point, we could go into a correction here, and that will pull on any band trades that you're putting on, like URA. If there's a big down day in the stock market, URA could have a very big down day and give back all those gains in a day. So just be defensive, knowing we're on borrowed time right now. Any extra trades you put on, I believe, are kind of icing on the cake. So protect it as much as you can. And it's better to have I think in this market environment, a tighter stop and get shaken out, but lock in gains on a trade like URA than it is to swing for the fence and think you're going to lock in another 10, 20, 40% on it. Let's take a look at the VIX real quick. Now, we had some panic selling, which we saw in this 30-minute chart over here. It was just a tiny little bout of panic selling, and pretty much the next day, we saw that panic carry over into the VIX. Now, our panic selling indicator has nothing to do with the VIX. It has to do with money flow in the New York Stock Exchange. Again, I show this formula. I have a new version of my Technical Trading Mastery book coming out, which I've updated and put in the indicator names. And I've got a section in the back that has how to set up a 30-minute chart, all of these indicators, the formulas, the settings. Same with these shaded red overbought territories, oversold territories, how to put all that. The book should be live on Amazon in a few days. We're just waiting on the editor to give the final approval there. But long story short, we had short-term panic selling with one indicator, and then that panic carries over to the next day, which was yesterday, and we saw the VIX have a spike up and pop. And we can see here with the VIX, you can see that little wick up yesterday. But believe it or not, what happens is the market, if it starts pushing to all-time highs again, people are going to have more FOMO. People who keep betting against the market, expecting it to go down, are going to realize they don't know what they're doing. They are, unfortunately, you don't want to bet against the market. That's like the worst thing you can do because the market can continue forever in the direction. A trend is more likely to continue than it is to reverse, so you're on the wrong side. If the VIX continues to fall and we see this stock market have a pop to the upside, which is what I think is going to happen, we're going to see another bout of people throwing in the rug, realizing that they're on the wrong side, they're losing money while the stock market's going higher. Instead of just riding it up like we're doing with the S&P 500 and the NASDAQ trade and all of that stuff. So just be aware, there's not a lot of fear in this market. The VIX is low, and we just had a little bit of fear just kind of flush out. So the market is primed and ready for that pop to the upside, which again, the S&P 500 shows us that we had a little short-term pivot low, short-term panic, and I don't have the indicator on here, but we also had that cycle low. So this market is primed and ready for a push higher, and hopefully you're on the right side of the market playing to the upside like we are. Anyway, that's it for now. We'll see how things unfold, and we'll go from there. Take care. Bye-bye.